Good afternoon, everyone. Welcome to another one of our Wednesday market reviews. My name is Stock Darts, and as usual, we're going to go ahead and take a look at the four major market ETFs. We're going to look at the S&P 500, the Nasdaq Composite, the Dow Jones, and the Russell 2000. Once we finish looking at that, we'll look at the US dollar, see how it's behaving, see how it's affecting gold, silver, and oil, and then we'll move on to chart requests if anyone has any. If you like what you see here, you can always follow me on Twitter at StockDarts. You can find my videos on YouTube at StockDarts, or you can visit me at patreon.com/StockDarts, where I post weekly blog content, usually watch list ideas or trade ideas throughout the week. Other than that, let's go ahead and get started. First things we want to do is look at the ETF SPY, which of course is the one that represents the S&P 500. Now, as you can see, overall things are pretty good. We did have a weak opening to start this week. A bit of a sell-off on Monday, but that was off of all-time highs. And I think overall the market is still holding up in a pretty good place. As I mentioned this week on Patreon, hey Ray, good to see you in here. I'm glad you're here, and hopefully you guys had a good holiday. Those of you that are in here now, I hope you had a good Thanksgiving. We couldn't meet last week, but we were back this week, and hopefully the week has been good to you. As I was saying, we had a bit of a weak opening to start this week, but overall the markets I think are still holding up pretty well. I think a pullback was something that we needed, something that was sort of expected. We last time we met, which was a couple of weeks ago, we had pointed out this ascending wedge. And as you can see, we finally did break down below it. It's again something that's needed. A lot of times when the price action gets stretched out like this, it becomes more increasingly difficult to try to get long, because the market puts you in a position where it's trying to force you to chase the price action higher, and you get worse and worse risk reward the higher up you try to chase the price action. So it's good that we finally had a little bit of a shakeout. I think that there may be room, or there may be potential for another shakeout, so we have to keep that in mind. Once you have that first move back down, that retest of that breakdown point and the retest of highs becomes kind of critical and something to watch. Now, we did also break the 20-pair moving average, which is not that concerning, but it is something to watch. Typically, when you have a strong trend that's beginning, you don't like that first test of the 20-pair moving average to fail. And that's kind of where we are right now, as we drop below it and we're right back above it today as we try to maintain the price action above that. And that's kind of where we stand at the moment. Is a market that has been strong over the last couple of months and is now beginning to finally pull back. And the question is, what kind of pullback can we expect, and at what point can we start buying the dip? I think because of the nature of what I'm seeing out of the price action, it's okay to start looking at buying dips already. And the question becomes more along the lines of making sure that the stocks that you are looking at are setting up in a place that give you good risk reward despite what the market is doing. I think that what we're going to have now for the next week or two is probably a market that is going to start to try to figure out whether it needs to pull back further or bounce, but there will be individual names that will bounce already and start moving ahead of the market, and some that are going to kind of lag behind it. One thing that's been sort of descriptive of the last 3 or 4 months with the market is that we've been in a little bit of a stock pickers market, where there's a lot of names that aren't exactly mimicking the market too closely, too accurately. There's a lot of names that are doing their own thing and are moving in patterns that are pretty different to what we're seeing out of the market. I mentioned that again a couple weeks ago when we met. We went over the FANG stocks, and I mentioned how they aren't really trading in the same sort of pattern, and showing that there is a little bit of discontinuity in the market right now. And I think that that's still continuing, and we'll get to that in a second when we get to the Nasdaq. And I think as long as we see that, we can assume that we're in more of a stock picking market, where the stocks that we choose make a difference. When a market is really strong or really weak, all stocks kind of move together, and it really doesn't matter what you're picking, as long as you're using the correct instrument to control your risk and your reward. But in situations like this, it does make a difference what you are picking, and it makes sense to make sure that you are using or searching for the right types of stocks, and you're remaining disciplined in how you go ahead and proceed and enter these. But we'll get to that in a second. Now, as far as the S&P 500 is concerned, we we actually pulled back a little bit, but nothing out of this world. I think, as I mentioned before, as long as we hold above 302, as long as we hold above the previous resistance level that we encountered throughout most of the summer, if you think back to where we spend most of the summer trading, it was between about 302 and about 281, 282 on the S&P 500 on SPY. And as long as we stay above that, again, things are looking really strong for the breakout that we're experiencing, and I again expect a pretty strong rally as we close out the year. And I think that's the one thing I want to point or make sure that I emphasize is that despite what I may say about weakness in the short term or the chance that the market needs to shake us out a little bit more, I think overall we are in a very strong market, a market that's looking to go higher, and we should all be looking to take advantage of this by trading to the long side. At this point, I don't think anyone should be thinking about short trades or worried about sort of reducing exposure to the market or stopping out on stocks that are doing well. That doesn't mean you should just bury your head in the sand and not take losses if stocks go against you. But overall, we should be in an aggressive stance right now. We should be looking to take advantage of upside momentum, not fearful of a market that pulled back 1 or 2 days at all-time highs. So that's the one thing I want to make sure that I emphasize is very clearly is that we are in a bull market, we're in a rally, and the market wants higher. So even if we do see selling in the next couple of days, or even throughout the rest of this week and into next week, I am looking at that as a buying opportunity. And my focus this week and the last couple of weeks, and probably for the rest of 2019, is to trade to the long side to take advantage of momentum as it begins to appear to the long side. Okay. Now that being said, where we stand right now in the S&P 500, there is more room to the downside, and I think as long as we hold above 302 to 303, then nothing has changed, and we're still in a very strong market. Again, if you go back and take a look at the weekly chart and see where we stand right now, you can see that we've had a nice liftoff. We've taken off. We've broken out of the range that we spent the last year and a half, almost 2 years in. And at this point, really what we're doing is waiting to kind of confirm that breakout by pulling back, retesting what was resistance that should now act as support, and then moving on from there. And I think overall, there's absolutely zero that you could say about this chart that's negative. Everything here is positive. Everything here has gone according to plan, according to how technical analysis normally works, how normal trade price action behaves, and everything here is pointing towards a continued rally higher. And I think that's where we should be looking, is taking advantage of this and making sure that we catch the next move higher, whether it's occurring now or whether it occurs over the next week. So now the next question is, what happens if we don't pull back all the way to 302, which we probably won't, right? Again, that's kind of the line in the sand. As long as we stay above that, things are very bullish, and we can look to trade to the long side. But if we just trade it up to here and we're already bouncing and we're going to kind of bounce back to the top, well, what's the next thing? What can we expect next, right? And that's where things get a little bit tricky, because I think at the moment what we're starting to form here is kind of a counter trend move after the rising wedge that we had recently. So I do think that this bounce that we're getting today is likely going to head back up towards the 312, 313 area, and then we should probably stall out at that level as we wait for the momentum to kind of continue and decide whether we need to pull back and test all the way down to 302, or whether the test that we had yesterday and Monday was enough for us. And so that's where we stand right now, is we're in the process of trying to figure out if we have enough buyers left to push through the supply that we finally encountered over the last couple of days. And I think as long as we stay above the lows that we printed yesterday, then we're just going to spend a few more days here and then probably try to break past it. If we come back and revisit those lows, there's a very good chance that we're going to have to come back down and test 302, 302.50, 302.30, this area just below just above 301. And I think that's really what we want to look at if we're looking at the S&P 500, is those two levels, right? We want to look at 307 and we want to look at 302, 301. And those are the 2 points that we want to pay attention to. And if we want to buy the dip, we want to buy the dip somewhere in that area. Now, like I said, if you are looking to trade, I wouldn't trade something that's trading exactly like SPY. I'd look at something that's trading a little bit different and trading with a little bit of a more narrow range of possibilities. Something similar to what we've traded and what we've traded recently in our our Patreon page, recommended trades that we've looked at the last couple of weeks. So, for instance, something like BE, which actually ended up stopping out, but you can see there was a nice tight range. Another one which was recent, which is actually working out good this week, is REGI, right? And again, so what we're looking for here, tight ranges with good risk reward, and clear-cut points of entry and clear-cut points of exit, right? And so BE, again, even though it ended up stopping out, we did have partial profits on it. We have clear-cut points of entry and clear-cut points of exit, right? And so you know exactly where you're entering, you know exactly where you're stopping, and you know your risk-reward is good. And in this particular case, we had a breakout, and it worked to our favor, at least up to the very first point when we had our first scale out, but we never got our actual, the full target that we wanted, around $8. But you have a clear stop out. There's not a lot of gray area for us, and it's the same thing with REGI. There's not a lot of gray area here. You know exactly where you want to enter, you know exactly where you want to stop out, and you know exactly where your targets are. And so those are the kinds of trades you want to focus on, rather than these more open-ended trades. Like, trading the S&P 500 right now is not a great idea unless you bought yesterday's hammer, which is really not that great of an idea either. Because as we stand right now, you've got about 4 points of downside, and you've got maybe 4 points of upside. So we're kind of in the middle of this broad consolidation, this almost like a bull flag that we are starting to print out. But like I said, we're in a bit of a stock pickers market, and what we want to do right now is look at stocks that are giving us better risk reward and better patterns of possible entry than what we're seeing on the S&P 500 or the NASDAQ, for instance. But we'll get to that again as we move forward. Now, what if we do sell off? What if we continue to sell off over the next couple of weeks? Well, as long as we hold above 302, again, I think it's a buy the dip opportunity, and I think that we should still be trading to the long side. But if we lose 302 and we start to head down towards the 290s, well, then maybe we need to be a little bit more careful. But I still think it's a buying opportunity, and I think that there's going to have to be a lot of carnage in the market before I change my stance on trying to buy dips and trying to buy bounces. Because even if we come all the way down to 293, 294, in the bigger scheme of things, we're still really just retesting our breakout from a previous range, and there is room to come down and test those areas without us really endangering or having a market that's in danger of changing its direction in the longer term picture. So while we're using 302 as a definition of the near-term health of the stock market, as long as we're above the 200-pair moving average, as long as we're above about 293, things are still overall very, very healthy. And if we lose that, then we have to come back and reassess where we stand. But I do not anticipate dropping below that in 2019. And that might be something that we have to explore next year at the beginning. But for now, I'm under the impression that we are going to have a pretty nice holiday rally, which has already started. And I expect us to continue trying to push to new highs as we approach Christmas. Okay, and again, I think that as traders right now, we should be more aggressive, and we should be looking to take advantage of trades that are setting up breakouts and setting up to push to the upside, as long as we continue to maintain our discipline and not chase price action higher. I think the price action we've seen in the S&P 500 over the last 3 days is the perfect example of why you don't want to chase price action. This is the exact kind of trap the market always lays. It continues to inch upwards and sort of not give buyers a chance to get in at lower prices, and once they finally jump in, that's when it finally drops it and kind of pulls the rug from underneath them, and that's when you get that drop, and then eventually the smart money comes back in and takes advantage of that drop, and that's why you always want to make sure that you don't chase price action and make sure that you're buying at right opportunities. And that doesn't mean you can't buy breakouts, but you have to buy breakouts that are giving you good risk reward. You don't want to buy stocks that are at highs that have already broken out. And so that's where we stand with the S&P 500. As we move to the NASDAQ, we'll see a very similar picture. Um, it's kind of hard when you get these wicks based off of this. You don't really see those wicks when you look at the 5 minute chart, but when you look at the daily chart, it makes it a little bit more difficult to really figure out what's going on here. Sometimes this is just one trade or something. I don't think that we really went down to 193, right? Did we? Actually, wait, what am I doing? I think the meat of the price action was basically 200 to 199, so that's kind of where we'll kind of really reassess what's going on here. So really, we were really trading right around here, and I think again it's the same picture as the S&P 500. What we've got right now is a market that's starting to find some selling, and again you had the same sort of ascending channel, almost like a market like a little short squeeze as the market was pushing higher, and we finally found some sellers, and we pushed the market down here, and we tested the 20-pair moving average, dropped a little bit below it, and now we've reached the point where we found some buyers again, but we're not really ready to move forward. I think again, like I said, I'm not that excited about the patterns I'm seeing out of the actual market indices right now. I think individual names that I find look better or worse compared to what we're seeing here. And a perfect example of this, again, will be with the Qs, is we're going to look at the FANG stocks. This will show you the disparity between the individual components of the market right now. So if you look at Facebook, you look at what it's doing, and I'd say this is pretty close to what the stock market in general is doing. It's a little bit, it hasn't actually hit new all-time highs, so it's a little bit relatively weak speaking. You compare that to Apple, and Apple has been pretty strong, kind of leading the way higher, much stronger than the overall markets. As you can see, this was the breakout from the previous highs that we had, and it's been actually marching higher for quite a while. And although, as you can see, over the last 2 or 3 days, it's done very similar to what we're seeing in the market, I'd say overall this is a pretty good sign of relative strength. You compare that to Amazon, and you can see Amazon is a completely different place altogether. Trading in a little bit of an ascending channel, just like the others, but a much more shallow one and much closer to support levels. And again, showing you that there's a little bit of there's quite a discrepancy going on right now between a lot of the individual components, and this is why I mentioned earlier that I think we're in a little bit of a stock pickers market where it matters what stocks we're looking at. Now, I know most traders will say, well, it always matters what stocks you pick, and yes, to a certain extent it does, but more often than not, most stocks are pretty strongly correlated to the market, and as long as you follow what the market's doing, you can pick a lot of stocks that are doing something similar, and in those situations, it's a little bit easier to really figure out what's going on because so many stocks are doing the same thing. But what we have right now is a market where a lot of stocks are doing pretty different things, and it makes sense to it kind of rewards the traders that are diligent and know what they're looking for and what they're trying to figure out and find. And so again, what I see here is a market that again still has a lot of cross currents, and despite the fact that I think that we're breaking out, I think that we still need a little bit of more time for all of them to get together and move together, and that's why we're starting to see a little bit of selling pressure here, because there's still some cross currents that need to kind of get fully aligned before we have the big rally that I'm expecting or looking for. So again, Amazon, relatively speaking, weaker. I thought Amazon presented a nice buying opportunity as it approached the bottom of this channel. I don't know that it's fully there yet, but it's one to watch. Next up, we have Netflix, and again, you can see not a little bit more like Amazon and not really like Apple or Facebook for that matter, which are printing near highs. Again, you have kind of the rising channel. So all of them have been climbing, just at different paces and relative to different parts of or different areas of their chart. And then finally, the last one is Google. And Google is more like the stock market, right, where it's trading near highs, and kind of doing the same thing that the stock market's doing. So I think overall, like I said before, when you look at the FANG stocks, I think they give you a nice little microcosm of what's going on in the market, and the fact that underneath the surface there are a lot of charts that are doing different things that aren't exactly the same as the overall market. And I think when you have an environment like that, you really should be diligent about what you're looking for and disciplined, and make sure that you look for the stocks that are giving you the good risk reward, and not necessarily just picking the big names that you're comfortable with because you know the name. Um, and so that's where we stand. Now, as far as the Qs, again, we just crossed the 20-pair moving average, and we got a long way to go to test the 50-pair moving average for real. And this is the same line in the sand as what we had in the S&P 500. Is around 195 on the Qs. As long as we hold above that, things are very bullish, and it means that we're still above the previous range that we spent the last couple of years in. And in reality, this 195 is actually the range we just spent the late summer in. And really the key area to watch is 187, which again is very far away and not a level that I expect us to reach this year. So I think overall things are very strong, and it's just a matter of waiting for this consolidation to flesh itself out and to figure out exactly where the buyers and the sellers stand in the short term. But I think in the intermediate to long term, all signs are still pointing up, and I think that we should still be looking upwards and looking to take advantage of bullish momentum. Now, as we move on to the Dow Jones, you'll note something very similar. We had the drop on Monday, the drop on Tuesday, and then we had a little bit of a bounce today. Now, the Dow Jones, relatively speaking, has been weaker. Let's take a look at the 5-minute chart and make sure that price action led all the way down there. Yeah, 273. So the Dow Jones has been, relatively speaking, weaker than the Nasdaq and the S&P 500, but I don't think there's much to take out of that. There's always going to be pockets of weakness in a market, and I think just right now some of the Dow components are struggling. But I think overall it's doing exactly the same thing as the S&P 500 and the Nasdaq, which is consolidating just below all-time highs and kind of struggling with the selling that we just saw the last couple of days. But I think overall still consolidating above the previous range, which we spent most of summer in, which again was a range that was held above the range we spent most of the last year and a half in. So the market's stair-stepping clearly and slowly making its way upwards towards new highs and setting up for a pretty strong rally. Now, the same as the other two, we have this level around 273, which is kind of a line in the sand. And just below that, we have the other key level around 265. Those are the two areas that we want to watch for support over the coming weeks. And as long as we stay above that, we should be bullish and we should be looking to trade to the long side. Now, I know I'm kind of glossing over the fact that we can pull back through these and we can end up in a market that's a little bit more tricky, but those are the levels that we watch. And if those levels get violated, that's when we decide to sort of reassess where we stand and to try to figure out what we want to do next. And I think that the clear signal for us is IWM. And that's the one we're going to look at next, and I'll point out what levels I think are important in IWM and which ones I think make more of a difference as far as how we want to go ahead and approach trading. But as far as the S&P 500, the Nasdaq, and the Dow Jones are concerned, there's more room for us to pull back and still remain in bullish environments. And I think the key here is really to understand where we stand within framework with where we want to go. And that's why I've been pointing out the levels of support and not really trying to understand what happens below them, because I don't think we're going to fall below them. I think if we're going to lose technical levels on one of the indices, it's going to be IWM, and I think that's the one that's kind of the one we should be watching as far as that's concerned. So if we look at IWM, you can see that we went right back to 158, 159 yesterday, and that's the important level. If you're worried about the stock market, or at least about where we stand right now in the short term and what kind of bullish momentum we can expect, this is the key to watch. Now, if IWM loses 159, that doesn't mean that we're in a bear market at all. I think that just means that we are in a slower bull market, very similar to what we've had all year. But as long as IWM stays above 158 to 159, I think we're in a market that has explosive potential to the upside. And I think a market that has a lot of, can really give us some good returns as we close out December of this year. And we had that strong bounce yesterday and today. And as long as it stays above that, like I said, my eyes are looking upwards, and I'm looking to trade to the long side. And I'm not looking to really hedge any bets. I'm looking to make sure I take advantage of a market that can start to really ramp up when we least expect it. Scaling back a bit, we could see just how important that 159 level has been all year. It's been a critical level, and every time that we failed to break above it, the market had a decent correction this year, and we finally were able to break above it. And as you can see, when we look at the weekly chart, there's a nice little vacuum here of price action for IWM. There's plenty of upside here with not a lot of price action, not a lot of potential supply to hold it back. So I think that there's potential for some nice upside action on IWM and on small caps in general. And that was one of the focuses that I had this week and the last week, was trying to find small caps. And that was one of the reasons that we looked at something like REGI, was because it was a small cap that had a very similar pattern to IWM. You can see it had a lot of trouble dealing with this level here, a horizontal price level. And once it broke above it, it started consolidating and building up steam to really break out. And then we finally had that big breakout, very similar to what IWM has done recently. And the hope is that there are other small caps that can do something similar and can start to climb and can start to play catch up and explore some of this ground they need to make up to catch up to the other indices and get to all-time highs. And I think that's really that's the key right now for the market and for trading in general as we close out 2019, is will the small caps continue to play catch up and make their way towards all-time highs? Because if they do, that's a lot of potential return that we can be taking advantage of. Again, you look at the weekly chart, you see where IWM stands compared to the other three indices, and this is a big breakout. Being able to push past 158, 159 was critical. For those of you that are regular viewers here, you know this is a price level that I've been watching for several months now. And if all things go according to plan, which you never know with the market, of course, that's why we maintain our discipline and why we use stops and all that. But if things go according to plan, there's a lot of upward potential on small caps in general. And there's a lot of potential return in the markets if the small caps go ahead and start to try to get to all-time highs. And so that's really where we stand right now as far as the market is concerned. I think in general, I'm focusing more on small caps right now. I'm focusing on names that they have room to make up, and they have room to look up and try to catch up to where the S&P 500 and the NASDAQ are right now. So if you look at the SPY and you look at the Qs, they're at all-time highs, but they look like they're a little sluggish right now, and they need a little bit of time to sort of consolidate and figure out where they want to go next. And then you have something like the small caps that is starting to confirm a breakout and has a lot of upward potential if they can continue to climb. And so I think what we might see from here to the next week or two is the small caps playing a little bit of catch-up while the other three indices consolidate and try to figure out where they want to go next. And they might drift a little bit higher, because if the small caps rally strongly, then the other indices are going to follow. But in general, that's what I'm looking at, and so my focus right now, more than anything, is on small caps, but it's on making sure I find names that are giving me good risk-reward, and aren't necessarily in the same place the indices are. Because again, even IWM right now, it's at 161. We've got 3 or 4 points of downside, and we've got maybe not even 1 or 2 points of upside before we reach the highs from last week. So risk reward isn't great if you're just looking at IWM as an index. So what you need to do is make sure that you find stocks that are either ahead or behind IWM. And what I mean by that is they're either ahead in that they've already sort of come back and retested and are starting to push to new highs, or behind in that they are now at the point of retesting a breakout and setting up a better risk-reward opportunity to go ahead and start climbing with them. So that's where we stand with the four major markets. I think overall we're in a strong market that I think is looking to really push the envelope as we close out the year. And I'm going to be aggressive trading. And try to take as many long trades as I can, but with discipline. I'm not going to chase price action. I never do that, and I don't recommend anyone else does either. Let's take a look at the U.S. dollar. We'll look at oil, gold, and silver, and then we'll move on to chart quests. I saw, Ray, you are... It's funny, I mentioned I wouldn't short anything, and you just said you're short using options on quite a few things, but we'll go over that stuff in a minute. Anyone else that has a chart request? I'd love to see what you guys are looking at. One of the charts that someone asked last week, AMD, actually ended up being a stock that I traded this week. So, or actually, they were asked about 2 weeks ago. So you never know. Whatever you guys are looking at, it can end up giving us a good trading opportunity, even if it's sometimes maybe a week or two after. But we'll get to that in a second. Let's look at UUP and the U.S. dollar. As you can see, the U.S. dollar has lost a little bit of ground over the last 3 or 4 days. I think overall, in the bigger scheme of things, it's still not in a bad place. It's still attempting to hold up towards highs, and really just trading sideways as it consolidates. Now, if you think about it, if you look at the euro US dollar, which is it's going to be a mirror image of that because this is based off of the euro chart. The euro has really been struggling to maintain and trying to establish a bottom. I think it has established a bottom, and I think right now it's in the process of trying to build a base. And I think that's basically what we're seeing in inverse on the UUP index, which is a stock that has kind of reached highs that it can't really push past. And while it's not ready to pull back and drop, it's just sort of establishing a base and starting to trade sideways as it continues to bounce back and forth between the supply and demand that's in these levels. And I think that's what we're seeing in the inverse picture of the euro US dollar. It's the euro finally found a place of stability and is just trading sideways and kind of ranging back and forth between the area right around 109 and about 112. And it's kind of smack in the middle of that right now. So there's room to go back and forth on this, and I think that there's room for the US dollar to fluctuate as well. If we look at the US versus the Canadian, we have a little bit of a different picture, but it's sort of the same thing, which is the US dollar has found a spot that it's trading in, and it's just going back and forth through there. You can see that it's really struggling to break through 133, but also has found a pretty good bottom right around the low 130s. And it actually had a lot of selling pressure come in today, and it lost that level once again. And at this point, it looks like it wants to head back down, probably find some intermediate support somewhere in the 131 area, but probably wants to come all the way down to the 130s again. And if we look at the US versus the yen, a little bit of a different picture, but the US dollar is finding support here. This was a trade we looked at a couple weeks ago, a potential bounce play off of this retest of support, and it actually had a nice move, and although it's faded it all back, that was a nice trade for anyone that took that trade, and it's starting to find support here again. It probably bounces again at this level. Again, there was a nice inverse head and shoulders as it tried to find a bottom here around the 108 to 105 area, and although it failed that first breakout, it looks like it's finding support again. There's probably at least one more bounce before it figures out whether it needs to fail that or not. But the one thing I could point out is when you look at all three of those, they're all doing pretty different things. And I don't think that there's a lot of consensus right now on what the US dollar wants to do versus different currency crosses. And so it's leading to a little bit of aimless direction, and why, as an aggregate, we're seeing the U.S. dollar just sort of drift back and forth. It doesn't really know where it wants to go next. And unfortunately for gold and silver, that means that they've been struggling as well. As you can see, GLD, kind of a bearish pattern right now, as it's really struggled to hold above 140, and it's kind of come back down. And you can see it tried to bounce and failed, and it's trying to bounce again. And kind of struggling with this area. And I think overall just in the same thing as the US dollar, not really sure where it wants to go next. I don't see this as something to buy at the moment. I think it would need to get back above 140 before I'd be interested in it. Ray, you said you're long gold with 1220 calls, so you have calls that expire in a couple of weeks. Unless you bought them a few days ago, I'm not so sure about that. So there is a potential double bottom here, right? So I don't want to say that there's no hope here, but I don't like the fact that we're below 140, that all the moving averages are curling down, and that the U.S. dollar is kind of struggling here. But That being said, you rolled them from 2 weeks ago. Oh, so you okay? That being said, so if the euro can bounce and get back, if the euro can make its way back up to 111, 112, then I think that that could relieve some pressure on gold and silver and lead the way higher. But I've kind of been off of gold ever since we had that rollover. That we looked at when it was up here and it was okay. Once it rolled over uh, in the middle of November, I've kind of been off it because it's below. It's on the wrong side of a lot of technical levels here. Um, and until it breaks them, I think that it's in a bad place. And I think if it does break them, it's still not really a trading opportunity because of where the risk reward lies in that place. So at the moment, I don't know. I'm kind of hesitant to recommend anything with gold and silver because I think that they're in the wrong place. I think that they're on the wrong side of a lot of potential levels of support or resistance. And until something changes, it's hard to really get behind that. Now, that being said, the U.S. dollar is kind of trading in a little listlessly, and there's always the possibility that these things catch a bid if the U.S. dollar isn't putting pressure on them. But at the moment, I'm not excited about what I'm seeing here. Also, for those of you that know, I was trading gold and silver with miners, and you can see KL had a pretty big gap down, and a pretty big, pretty drastic move to the downside. So this to me was another sign telling me to, warning me off of miners for now, or off of gold names. And then lastly, we have oil, and oil's all over the place. You can see it's just going back and forth between 55 and 60. It had a pretty big reversal, and then it had a pretty big reversal again. It is maintaining this trajectory to a certain extent, and it's really struggling to break past this 58, 59 area. And to tell you the truth, I'm not really looking at oil names right now either, because I can't really get a good sense of what oil wants to do next, and until I see a clearer direction from it, it's just noise. It's just going back and forth a lot, and it's a lot of noise that is difficult to take advantage of unless you're day trading or you're taking these sort of swing scalps where you're just holding the name for a day or two. Okay, so for now, I'm not on that either. Yeah, Ray, your gold trade has probably been a pretty messy trade. I think that sometimes that's why I don't like to roll. Like you said, you rolled it from 2 weeks ago. I know you tend to have trouble sometimes giving up on trades, especially with gold. Sometimes it's better to just stop out and just reanalyze. Because the longer you're in a trade, the more, the harder it is to watch it from an unbiased perspective. All right, so let's take a look at. We're done with oil, gold, and silver. Let's take a look at chart requests. Ray, you also mentioned your short Microsoft. Now again, I for those of you that maybe aren't aware, and you're kind of worried about it putting a chart request because you think I'm going to attack you on it or not, I try to point out whatever I can the positive on any of these trades or what I think, but I'm not going to pull punches on, especially someone like Ray that's taken a lot of mentoring with me. Ray's someone I've mentored for a while. He likes to do his own thing and sometimes ignores what I tell him. So, Ray, I'm kind of curious. Why are you shorting Microsoft here? If we look at it, you look at the long term, and the only thing I can think of is it's high. And I think this is a trap that a lot of traders get into, is this idea that gravity is going to affect the price chart, and if a stock is up so much that it needs to come down. And the truth is that, yeah, stocks ebb and flow. There's always going to be an up and a down to it, but what ends up happening is when you short names that are really strong, you put yourself in a really difficult position because there are always buyers that want to come in and take advantage of these drops, right? And you look at Microsoft and you look at what it's done over the last year. You look at, right, actually we're not even going to bother. We'll just look at the big picture. You look at what Microsoft has done, and it's been kind of just climbing, right? You had the nice climb higher. You had this consolidation. Then it kind of came up and formed a really nice base. It broke out. It did the nice little tight flag before it confirmed the breakout and continued upwards. And yeah, over the last couple of days, it's pulled back along with the markets, right? But I think overall, there's not a lot to get excited about shorting here because again, this is a stock that's been climbing steadily, not only all year, really, for the last several years, right? Look at what it's done over just from 2016. It's just been going up, you know. And there have been pullbacks and there have been moments where it's kind of dropped, but those have always been bought up and it's always continued upwards. So when I look at something like this and you say, yeah, I'm shorting it. What I think is someone that's getting cute and trying to time. They're just like, well, the stock's been up so many days in a row now, it's got to drop, right? And I know that's pretty much probably what you're thinking. Yes, it looks high, same as Apple Trade, got burned on it, so looking for a quick drop to exit. So it's the same sort of idea, and you just got your quick drop actually. But when I go over the stock market, right, and I mentioned how I'm looking to buy. I'm looking, everything. If you notice, everything I said today for the first half hour was I'm going to buy, look up. I want everything to go long plays only, looking, buying. And the reason for that is because this is a market that's looking to go upwards, right? And what we have here is a stock that's following the market upwards. And what happens is you tell yourself, well, it's got to reverse, right? And there you go. You said it. I'm always wanting to get the reversal. And you know what, Ray? I have the same sort of inherent bias as you in that I usually look at stocks. I think, well, I always favor reversion to the mean. I always think something's going to come back. But here's the thing. Even if it does come back, it's not going to be an easy trade because there's so much demand in the market right now. There's so much demand in a stock like this that even if you catch the one down day, there's going to be buyers that step in immediately, and they're going to make this a very difficult trade for you because it's never going to have a clean move down to your support level. There's always going to be back and forth, and there's going to be a lot of buying that comes in and supports the price. And then in the end, what happens is you get a stock that trades sideways for a week, and even though you might have been right about the fact that it was at resistance and that it was going to struggle, you don't get a good trade because there are too many buyers waiting to come in and take advantage of it. And so when you have that attitude, that mean reversion bias, what you have to do is understand the big picture. You have to understand where we stand as a market and take advantage of the mean reversion that's in the same direction, right? So in this case, if you think if you think something like Microsoft is going to pull back, well, don't try to short it. Wait for it to pull back and then trade the mean reversion of that and buy the dip. And so when I go over the market, and a lot of times, those of you that are regulars know this, when I'm looking at the S&P 500, I rarely actually trade SPY. What I'm doing is trying to understand what kind of environment we're in so I could recommend trades. And so what I'm doing in these situations is telling you something like Microsoft, you don't want to try to short this. You want to wait for the dip, and then you want to buy the dip. So a couple weeks ago, Blackhawk recommended AMD. What he didn't recommend it. He was like, I was obviously searching for a stock request, right? And he brought this up, and he's like, oh, here, maybe we could talk about this. And so what we pointed out was, this is the kind of name that is just too strong, right? You don't want to chase the price action up here, but at the same time, you don't want to short this because it's just too strong. It's going to be really difficult to take a short trade on this that's going to work in your favor. Almost exactly what I said 2 weeks ago. And so what happened is eventually it pulled back and it consolidated, right? And then it never did break out until today, but you have this consolidation range, and these are the stocks that instead of trying to short it, you can see if you tried to short it, you wouldn't, unless you traded it one day from 40.30 to 38, you didn't get a good trade on this. And what ended up happening was it eventually consolidated, and even on a breakdown yesterday below this level, you could see that there are so many buyers that came in and stepped up and gobbled it right back up to inside this pennant. And so this is what ends up happening is that you have a stock that's so strong that even when it does drop, there are buyers waiting to step in. And so look, and you had AMD on a list to short, but you didn't. Also eBay. So here's the thing, Ray. These are all stocks that are, well, eBay's different. eBay's not strong. eBay, well, the only thing I'd say about eBay is that this is a market that I'd rather be long than short. But this is, at least this has weakness in it. It's nothing like the other two. But something like AMD or Microsoft, rather than trying to short it just because it's strong, you're better off waiting for it to pull back and then trade that mean reversion and buy the dip. Because more often than not, what's going to happen is this is going to resolve back to the long side and continue climbing higher like it's done. And again, all you got to do is look back. Just take a look at what it's done over the last year, right? And you might tell yourself, well, yeah, but it's got to turn around at some point. Yeah, but you know, how many trades do you have to fail before it finally turns around in your favor? So what you want to do in these situations is just buy the dip every single time. Like, you'll be right 8 out of 9 times, and then when you're finally wrong, you're wrong and you stop out, but you would have been right so many times that it doesn't matter anymore. Right? Alright, so let's take a look. The other one you were looking at, XLV. Same idea, just a stock that's really strong. Is coming up to $100, which is a pretty key level, and this is an ETF, right, of healthcare. So I wouldn't be short this either. Like, it just, there's no sense to this. Yeah, it probably needs to pull back, but it's not an easy trade to take. So you're saying it's just hard to accept this market never stops going up, and I would say yes and no to that, Ray. Because if you think about it, yeah, the market continues to go up, but you know what? They keep lowering interest rates. Why is the market going to go down? But even that, like, if you look at it, the market doesn't always go up. I mean, it didn't really go up there was a good portion of last year and a good portion of this year where it traded sideways. And there were points in the market this year where short trades were viable. So there are opportunities if you want to go ahead and take advantage of downward bias, but I don't think right now is one of the times. And yeah, it's hard to accept that the market, but here's the thing, Ray, and this is not something just that affects you, it affects everybody. You look at it and you're like, well, this has to stop at some point. Yeah, it will. At some point this will stop. But until it does stop, take advantage of it. I mean, you'll be right more often than not. You know, that's the thing with these kinds of markets, is that sooner or later this will stop, and sooner or later we will get a real bear market. But until that happens, you're kind of wasting opportunities trying to predict it. And really, the only reason that you're trying to, like I said before, I look at the market and I analyze it and I figure out the points where I think the market will tell me that the price action is different. So when we looked at the S&P 500 earlier, I pointed out, well, all right, so here's a very short-term level of health, here's an intermediate-term level of health, and here's a longer-term level of health, right? So I have my gauges. I know if this market does stop going, I'll know because it violates these levels that I have put out. Until it violates those levels, I have no reason to doubt the market. I have no reason not to trust it, right? And so that's the best way of approaching this, is to understand that you can't, just because the market's up near highs, yes, one day it's going to roll over and it's going to top out in one place, right? It could be so let's say 315.55 ends up being the top, right? We're not going to know that for a long time. And anyone that says 315.55 was the top, I shorted there, is either someone that shorted 5 billion times before that or is lying. And the truth is that you can never guess when the market is going to roll over based off of the high print. You're only going to know this by figuring out at what point the market rolls over, when it starts to lose these key levels, when the direction starts to change. And right now the direction has not changed. The direction has not hinted at changing. And so that's why I put these levels. That's why I always watch these levels and say, this is my first line in the sand, this is my second line, this is my third line, is because those are the levels that warn us when the market is rolling over. And even all the way back in 2007, there were warning signals. The market didn't just one day crash. There were warning signals. And yeah, there will be times throughout history where the market is going to crash and it's going to be based off of one thing, one crazy news event. But that's once every 2 or 3 decades. And you can't live life expecting that to happen every day. You have to assume that more often than not, the market's going to trade based off of normal price action, normal market behavior, and judge it off of that. And so that's kind of where we are right now. We're in a strong market. We're in a market that wants to climb, And sure, maybe we top out, maybe we roll over here. But if we do roll over, we'll get warning signals. Well, the market will tell us that it's starting to lose ground. We'll see failed moves. We'll see failed breakouts. We'll see the moving averages roll over, and that's when we know we need to start adjusting our risk, and we need to start closing trades and raising cash in our IRA accounts and all that stuff. Until then, we should just be looking to take advantage of the upward bias, and so. We should be looking at those names that you're looking at. Stuff like Microsoft. I don't want to look at this as a short. I want to look at this as where can I get in? Where can I get in on this train that's been just going upwards for so long now? And it had such a nice base. So you're saying, one of the things you said was like it's hard when this market never stops going up. But if you think about it, look at Microsoft. It did stop going up. It traded sideways for quite a while before it finally started climbing higher. And so there are points where you can go ahead and try to get involved in these names. You just have to be patient. And if you miss them, you can't get too caught up in it and say, well, I missed it, I'm going to short it now, or I missed it, so I have to chase it. You just have to wait. There's always something else, or there's always next week or next month. So, hope that helps, Ray. Hope that helps anyone else. I know, some of the viewers in here, I think, tend to be a little bit more shy. They don't like to give me names that they're looking at or to kind of participate. But hopefully those of you that are listening, you're getting something positive out of this. And if you ever have any questions on any of this kind of stuff, guys, you can always email me, stockdarts@gmail.com. More than happy to help you. You can always find me on Discord. I'm more than willing to help you out there as well. You can message me on Twitter. You can DM me. And I can answer any questions or give you guys any advice you're looking for. If you're really kind of struggling with this market or you're really struggling over the last couple of years, I do offer mentoring. I can always help you guys. We can do one-on-one. It could be just as simple as a 1 or 2 hour session to try to get your head on straight, or it could be, trying to teach you from scratch. But if you're ever interested in any of that kind of stuff, just email me or message me on Twitter, and I'd be more than happy to help you out. All right, you said you guess you look too close. My theory is more longer swings. No, not necessarily, Ray. It could be for shorter swings. It could be for one or 2 day trades. I take profits a lot of times after 1 or 2 days. You want to be on the right side of the market momentum is really what I'm trying to get at. All right, folks. If we don't have any other chart requests, we can call it a day here. Ray, the other one you were looking at was EA. Let's look at that real quick. This one I still not happy with shorting the market right now, but EA has not been that strong, and it is range bound. So I can, this one's a little bit more acceptable. Kind of hard to really draw a resistance level on this though. I mean, you could say this, but that's like not really helping much. Let's look at the weekly chart real quick. Looking at EA now, right? All right, so here's a look at EA. EA has not been a great name for a while now. I tend to have a comfort level with the video game stocks, and I mean that. I think we could probably say something like this. So this one at least, Ray, is at resistance, and it's range bound. You can see it's clearly range bound. It is towards the upper edge of that range, and I think if the market continues to climb higher, EA will probably be able to break through 102. But for now, this one at least is kind of stuck in a range and is bumping its head up against what is pretty clear resistance. Now, it's a little bit harder to actually say exactly where the resistance level is on this, because you can see the first time it tried to bounce, it struggled around 106, and then it struggled around 104 to 102. And then 102 has become kind of a level to hold it back, and it's kind of up there now. So I won't disagree with shorting this one. I think at least this name is a name that's stuck in range bound, but it is changing direction. If you look at the moving averages and you look at the curl of the 20, the 50, and the 200, they've all flipped from a bearish stance to a bullish stance. You've got the 20 above the 50, above the 200. They're starting to spread out. So there is a trend that's beginning to develop on EA. I think 102 is a decent level of resistance. I think even if it gets above it, there's not going to be a conclusive breakout until it can get all the way past 105, 106. So this one could take some time, and if you're shorting call spreads on this, this could work in your favor. And I think this one is better than Microsoft. I don't, I could see someone shorting this, and I wouldn't argue with them. I would only say that the market, I still think that this is a market that's strong, and more likely than not, most names are going to continue breaking out as opposed to stay range bound. But for now, this one is range bound, and this one might take another few weeks to try to break out. So, this one could work out for you. I don't, this one's fine. Again, I'm not sure when you took the trade, but this is a level of resistance that it could struggle to deal with. But it is changing character here. You can see it clearly, and it is starting to find some upward momentum. So there is a chance that it tries to push through. Okay. All right. Well, Ray, thank you again for participating and for attending, and everyone else that's in here that stayed on the sidelines. Thank you for attending. I hope you guys get value out of this. You also, by the way, if you ever have feedback, I'm more than willing to listen. If you guys think that there's other things I should look at, maybe spend less time on gold and silver, whatever it is, let me know. And I'd be more than happy to start looking for different types of content for you guys. Thank you, Chester. Glad you attended as well. I hope you're getting something out of this. Like I said, if you guys ever have questions that you don't want to ask in public, you can always ask me in private, and I'm more than happy to answer them if I can. Okay? All right, guys. Have a good rest of this week, and we'll meet again next Wednesday.